When people think of venture capital, they often picture funding, big checks, high valuations, term sheets, and cap tables. But what's often overlooked is perhaps one of the most powerful assets a venture capital firm brings to the table: its network. The right investor doesn't just offer money, they offer access to talent, to markets, to customers, to partners. And when used effectively, that network becomes a multiplier. It speeds things up, smooths things out, and opens doors that a startup might never even have known existed. From building high-performing teams, to optimizing operations and economics, to unlocking partnerships and customers, the VC network can be one of the most valuable levers a founder has. Let's start with one of the most immediate challenges every growing startup faces: building a team. As startups scale, they transition from generalists who do a bit of everything to specialists who own specific outcomes. At that moment, often around Series A or B, hiring the right leaders becomes not just important, but essential. And this is where the VC network starts to make a real difference. A well-connected investor can introduce a founder to experienced operators who have built and led teams before, people who know what it takes to scale a company without breaking its culture. These aren't just names pulled from a database. They're vetted, trusted professionals the VC has seen in action, often across different portfolio companies. Whether it's a product lead who scaled a SaaS platform to tens of millions in ARR, or a head of talent who knows how to build recruiting infrastructure from the ground up, these introductions can accelerate hiring while lowering the risk of missteps. But it's not only about skill, it's about fit. A smart VC helps founders think through the kind of leadership they need, not just today, but a year from now. They coach them on how to maintain culture while scaling, how to onboard and align new hires, and even when not to hire. In a world where adding the wrong person at the wrong time can slow everything down, having access to the right people at the right moment can make all the difference. Beyond hiring, scaling a startup means making hundreds of operational decisions about pricing, about go-to-market strategy, about when to expand and when to pause. This is where experienced investors step in with more than just opinions. They bring benchmarks, patterns, and direct access to people who've already faced similar challenges. Take something as foundational as unit economics. A startup might be growing quickly, but if the math doesn't work, if it costs too much to acquire customers or margins are too thin, it won't last. Good VCs don't just point that out. They bring in experts, share case studies, and help model different scenarios. They help the founders zoom out, understand what's sustainable, and make decisions that set the company up for long-term success. In some cases, this means connecting founders with fractional CFOs or experienced operators who can pressure test assumptions. In others, it means introducing service providers, channel consultants, or even other founders who've tackled similar issues. That's the power of the network. It's not just advice, it's access to people who've done it before and are ready to help again. As a startup begins to find traction, the next natural step is often expansion: new geographies, new customer segments, new products. But moving too fast or choosing the wrong opportunity can be risky. This is another area where the right investor network can add real strategic value. Well-connected VCs don't just support expansion, they help shape it. They help assess whether a new market is ready and whether the startup is ready for it. They can connect founders to operators who've led similar expansions, to local advisors who know the landscape, and to potential customers in the new region. They help stress test the plan, looking at the costs, the competition, the regulatory environment, and the opportunity size. Sometimes expansion means entering a new geography. Sometimes it means going upmarket or downmarket. Sometimes it's about launching a new product line. In every case, the best investors act as a sounding board and a scout. They help the startup avoid common pitfalls, and they open the right doors to make expansion more efficient and less risky. Startups often think about partnerships later than they should. But in reality, the right partnership can change the game. It can drive distribution, enhance product credibility, and even unlock new revenue streams. And this is where investor networks can really shine. A VC firm with deep ties in a sector can introduce a startup to integration partners, platforms like Shopify, Salesforce, or Stripe that can bring built-in audiences. They can connect them with co-marketing allies or companies with complementary user bases. They know which enterprises are actively looking for innovation, which resellers have access to key buyers, and which channels can unlock scale without the need to build massive sales teams. These aren't just introductions, they're curated connections based on strategic alignment. The VC helps structure the deal, set expectations, and avoid partnerships that might look good on paper but deliver little value. In some cases, these introductions lead to pilot programs, joint ventures, or even long-term commercial agreements. In others, they spark collaboration that evolves over time. The key is, the VC brings relationships to the table that the startup wouldn't be able to access or even know about on their own. Ultimately, every startup lives or dies by its ability to find and keep customers. And here again, the VC network is often the most underrated resource. Investors who are deeply embedded in their industries can connect founders with potential clients, enterprise buyers, and key decision makers who can move the needle. These introductions go beyond warm leads. They carry credibility. When a well-respected VC vouches for a product, it lowers the barrier to entry, shortens the sales cycle, and gives the startup a chance to prove itself. For early-stage companies, that kind of credibility can mean everything. But customer acquisition isn't only about introductions. It's about helping the startup tell the right story, refine its pitch, and target the right segments. VCs who understand this will sit down with founders, challenge their assumptions, and help them focus their efforts. They'll encourage community building, thought leadership, and user advocacy, not just ad campaigns. Some of the fastest-growing companies got where they are by building communities that spread the word for them. And often, VCs helped light the spark. By supporting podcasts, online events, ambassador programs, or even customer-led content, VCs can help turn a startup's users into its biggest advocates. In the end, a venture firm's greatest asset isn't just capital, it's connectivity. The most impactful VCs don't win on check size alone. They win by showing up with the right people, the right insights, and the right doors already open. It's through networks that firms deliver real leverage, helping startups hire faster, operate smarter, expand more strategically, and reach customers they wouldn't otherwise access. For VCs, this means thinking of the network not as a list of contacts, but as a living system, constantly cultivated, deeply curated, and actively deployed. Every introduction, every shared lesson, every strategic connection is a chance to compound the value you bring as a partner. That's how reputations are built. That's how firms differentiate. And ultimately, that's how long-term returns are generated, not just through capital deployed, but through networks activated at the moments that matter most.